Now, we need to understand why investing in India is actually a long-term compounding story and why we should actually invest in India's growth story. Now, investing is ultimately about participating in long-term economic compounding rather than predicting short-term market movements. And India today stands at a structural inflection point supported by three reinforcing pillars. Number one is capacity, second is capability, and third is confidence. Now, India's economic foundation has strengthened on these three fronts. With respect to capacity, higher public capex in roads, railways, ports, power, and logistics is basically improving efficiency, while finance and digital infrastructure have also scaled up. If I talk about capability, a young workforce with improving skills, stronger corporate balance sheets, better insolvency recoveries, and more digitized execution-focused governments is taking place. Now, when I talk about confidence, households benefit from income visibility and stable inflation. Corporates from rising investments and exports and formalization as well. And the government from fiscal consolidation and policy continuity. So India's growth story is therefore not driven by a single reform or a short-term cycle. It is a result of multiple structural factors reinforcing each other over a long period of time. And that is physical capacity, financial capacity, technological capacity, individual capacity, enterprise capacity, governance capacity, individual confidence, enterprise confidence, and government confidence. Now, all of this combined will work towards India's growth story. But now coming to why small caps are more interesting and can generate excess returns. Now, this is because of a couple of factors and also data. One is a low base effect. Now, large companies are already scaled up, so growth tends to be gradual, whereas smaller companies can grow much faster simply by expanding and entering into new markets or also gaining export market share. Now, starting small gives them a natural advantage over long periods. And small caps outperform not simply because they are small, but because most of them successfully evolve into mid-sized and then large businesses over a long period of time. Now, here is the difference between the past and today. Small caps today are better businesses than in the past because many small cap companies have moved beyond that fragile balance sheets and inconsistent profits. They are running more disciplined operations, generating steadier cash flows, and they are growing with better financial control. And management has also realized all of this. And this makes their growth more durable than in any other cycle. Now, India's future leaders usually emerge from small cap space. Most new industries and niche opportunities do not begin with large corporations. They start with focused, smaller players who scale over time. And investing in these small caps will allow us to get exposure to businesses that may become tomorrow's leaders. And the problem here is small caps are under-researched, which means opportunity also comes. Because unlike large companies, many small caps receive limited analyst and investor attention. As a result, improvements in the business often take time to reflect in stock prices, and that delay creates the opportunity for patient research-driven investors, or we call it the arbitrage. Now, small caps also reward patience. Price volatility in small caps can be uncomfortable, but over time, stock prices tend to follow business performance. And investors who focus on long-term fundamentals rather than short-term price movements are more positioned to benefit over here. But obviously, we cannot go ahead with small cap before looking at the risks of investing. Now, one big problem in small cap is the lack of liquidity. Small cap stocks generally trade in lower volumes compared to large caps. This means buying or selling a large quantity can impact the stock price a lot. Now, during market stress, exiting positions may also take longer or happen at horrible, unfavorable prices. The number two problem here is higher volatility. Now, prices of small cap stocks tend to move sharply, both upward and downward. And even small changes in business outlook or market sentiment can lead to large price swings. Now, this can be uncomfortable for investors in the short term. Now, coming to point number 3 is higher risk of bankruptcy. Now, small companies often have less financial flexibility and fewer diversified revenue streams, and a business setback, funding issue, or execution failure can impact more severely than large firms. Now, this obviously increases the risk of business failure if things go wrong. Number 4 is lack of analyst coverage. Now, many small companies are not closely tracked by analysts or media, and as a result, information may be limited and business developments may not be immediately visible. Now, this increases the need for independent research and due diligence. And last point number 5, limited operating history. Most of the small cap companies have a shorter track record as listed entities. And with limited historical data, it becomes very hard to judge how business performs across different economic cycles. Now, this adds a certain level of uncertainty to long-term projections. A lot of people ask me, Shashank, what are the traits of a multi-bagger and how do I find small cap gems? Now, the truth is, in small caps, you're not hunting for cheap stocks. You're hunting for great businesses early. So I look for a few non-negotiables. Number one, it has to have a long runway where a market that is expanding for the next 10 to 20 years. Number two, if it has any kind of moat, something that protects the margins, protects the brand distribution, there is switching cost involved, niche leadership, that is what I like. Third is a clean balance sheet with low debt, cash generation, and good capex. And next, I look at quality management. Basically, they need to be honest with their communication, be a good capital allocator, and the promoter should have skin in the game. And finally, they should execute and compound their returns by increasing the return ratios and efficiencies. Now, not everyone wants to pick individual small caps, and that's fair. And that is why there are a lot of small cap funds in the market. Now, Grow recently has launched a small cap NFO. And if you're exploring it, I genuinely suggest you to read their scheme documents because they have shared a pretty interesting process note. And their framework is basically a pyramid framework. First is stock selection. Identify high quality, high growth companies. Second is investment decision. Growth is important, but only with strict valuation discipline. Now, third is entry. Even a great business can be a bad buy at a wrong price. So they focus on the entry levels. And fourth, they use sizing. A position sizing based on risk-reward ratio so that the downside doesn't wreck your complete portfolio. Also, the equity head, who is CA Anupam Tiwari, has also 2 decades of experience across the industry. But remember, experience and process are important, but they do not guarantee a successful outcome. Now, mutual fund investments are obviously subject to market risk, so please read all the scheme-related documents carefully before investing. Now, coming to the final part of this video. How do we find small cap companies by ourselves? Now, we truly believe in giving you more value than what you came for. So instead of just talking theory, we built a simple small cap quality plus growth screen based on your analysis. A starting point to shortlist potentially strong businesses. But again, a quick disclaimer, this is not a magic wand. A screen only filters numbers. It doesn't judge management quality, competitive moat, cyclicality of the business, and valuation comfort. For that, you have to do your own research before investing. Now let's talk about the screen. Market capitalization greater than 1,000 crores and market capitalization less than 20,000 crores. We will also do return on equity greater than 15%, return on capital employed greater than 15%, debt to equity less than 1, operating profit margin greater than 10%, P ratio less than 40, but sales growth over the last 5 years should be 15% and above, and profit growth over the last 5 years should also be 20% and above. The PEG ratio should be less than 1 and the pledged percentage should be 0. So this is a beautiful screen. So I hope you guys liked today's video and this small cap screen as well. And more importantly, I hope you understand how we can participate in India's long-term growth story by finding quality businesses early and holding them with a 20-year mindset. Now, the screen will obviously give you a lot of companies, but you need to do your qualitative research before deciding a company. Now, I hope you guys enjoyed this video, and if you did, please click on the like button and also click on the subscribe button so that we can keep giving you amazing knowledge like this. And until next time, this is me, Shashank Gorabai, signing off. Take care. See you. Bye-bye.